First, we'll just introduce everybody here and then a couple housekeeping items. So my name is John Newton. I work in family investment sales here in our San Diego UTC office. I'm also the capital markets division leader for our office here. And we have with us Melissa Lay and Ian Schroeder. They sit in our Newport office and are specifically dedicated to retail and net lease practice. A couple housekeeping items. So we do have the webinar format. You will be able to ask questions via our chat feature. So you can look down in the bottom there under the control section. You should see a Q&A button at any time during the webinar. If you have a question or you want additional information on a particular point or to go back on something, feel free to type something into the chat. We'll be able to see it and we'll try to address it as things go. We want this to be, informational and give you kind of the background information on TripleNet and everything that's in there. But we also want it to be, interactive, and I'll be asking questions as well to kind of feel some points that I hear a lot in the market and that might be pertinent to you guys. So with that, I'll hand it over to Melissa just to intro and kind of kick us off.
Yeah, hi everyone. My name is Melissa Lay. I am the Vice President of the Net Lease Property Group here in Newport Beach, and I also have my partner Ian Schroeder as well.
Yeah, good afternoon, everyone. We appreciate the time this afternoon, and we'll make a quick introduction, a little bit of background about our team. I've been doing single tenant net lease for the past 18 years. So I went through the 2008 cycle. It's our main focus as a team. Melissa and I are partners here. We sit in Newport Beach, but our practice is national. We are part of CBRE's specialty group. It's the single tenant net lease group. And there are about 6 or 7 teams across the country that specialize in net lease like we do. So we're part of that group. Our business is national. 80% in any given year of product that we sell is outside of California. We tend to move a lot of capital from California to other parts of the country. And net lease is like a bond offering. So we're able to sit here and be able to function across the state. So our team is 6 people. We have 2 support staff and 2 other junior brokers that are looking for deals and digging up deals. So again, we appreciate you having us on this afternoon.
So many of you may or may not be familiar with a single tenant net lease property. When we say that, we're referring to a single investment property with one lease, with one tenant. So think of deals like CVS, Walgreens, McDonald's, Chick-fil-A. So any type of building, it's one building on one parcel of land. And so you're only dealing with one, national credit tenant. So instead of getting, your rent from a mom and pop type tenant, you're getting your rent from a national retailer. And so the credit is of utmost importance when taking a look at these deals. There's a lot of reasons why people get into the net lease space, and here are just a few of the main reasons why many investors are attracted to it. I would say the number one reason is ease of management. A lot of these deals are absolute triple net, which means the tenant is taking care of all aspects regarding the property: taxes, insurance, building upkeep. So you're not going to get a call if there's a roof leak or something like that. They have long-term leases, anywhere from 10 to 15 to 20 years. It's a very steady source of income. You know what the next 20 years is going to look like. And so that's why people like them and are drawn to them. Credit worthiness of tenant is something that, we discussed, the minimal management obligations. And we like to call it a coupon clipper or mailbox money, where you simply just collect a rent check every month from the tenant that you have in place. And so it's a very simple type of investment. But again, there's a lot of nuances that having our team on your side would really benefit you in finding a property that is safe and secure. There's a lot of different things that go into valuing a triple net deal, and that's kind of where, again, we come in and we help you. Location. Like any piece of real estate, location does matter. Everything from ingress and egress to its position, where it sits on the street. Is it a hard corner location? Is it mid-block? Is it in an area that's growing demographic wise? Is it an affluent area? Is it in an income tax-free state? So that's a large portion of our job is looking at the actual real estate location itself. Credit of the tenant and your guarantor on the lease, again, is very important. Like Ian said, it is a bond backed by real estate, is like we like to say. So are you looking at something like a corporate credit deal, like McDonald's, or are you looking at more of a franchisee tenant deal, like something like a Taco Bell? And their ability, to pay you rent is of utmost importance, like I said. We did kind of touch on, the terms of these leases. They can be, 10, 15, 20 years. You can invest in a deal with a shorter term as well. It just depends on your overall investment strategy. Rental increases are very important, especially in the inflationary period that we find ourselves in right now. Typical rental increases on net lease deals are, 10% every 5 years. Sometimes you can get some annual increases. So again, that's just another factor that goes in when valuing the deals. And then tenant and building type, is it e-commerce proof? Does it have a drive-through? Is it a medical type tenant? Is it office? Is it industrial? And we've done, some industrial single tenant deals as well with someone like a FedEx. So there's a handful of things, and the bottom line is it's a risk versus reward. And so the better the credit, the longer term the lease, the lower the return than something that's going to be more, on the riskier side of the spectrum, such as like an office property or something like that. The lower the risk, the lower the cap rate, the higher the price. Alternatively, the higher the risk, the higher the cap rate, and the lower the price. So again, there's a lot of moving parts that go into valuing a deal. On the surface, it can appear, pretty easy to underwrite, but again, there's just so many factors that go in when you're looking at these deals. Ian, did I miss anything?
No, I think you hit everything good. Yep.
Yeah. So actually, Melissa, maybe we could just take a step back. So there's a lot of information there, and we want to be cognizant. A lot of the apartment owners may have heard of triple net, or they may have heard of somebody that went into it, or maybe you're just hearing about it for the first time. But maybe we could just take a step back and talk about really what a net lease property is and how it's different from apartments. Now, obviously, when you have an apartment building, you're very involved in the management. If you self-manage, you're paying all the bills on your own. If there's something that goes wrong with the building, that's 100% on the owner of that apartment building to pull out of their pocket to fix. And of course, when you're dealing with the turns, you're dealing with all the legalities of, toilets, tenants, and trash. And obviously at a certain point in life, a lot of apartment owners kind of get tired of that. So could you just talk a little bit more about retail leases and how a triple net and what exactly that means is from other retail investments, maybe like a double net or some of these other things, and that this is a very, very specific kind of retail ownership.
Right. Yeah, absolutely. So in addition to paying you rent every month, the tenant has to maintain. So they're doing the common area maintenance. They're doing the trash. They're doing security if they need it. They're doing light fixtures. So anything as it relates to the building or the improvements or the landscaping, driveway maintenance, all of that is going to be the tenant's responsibility. And so, like I said before, you're not getting a call when something goes wrong because, they are responsible for making all of those, to fixing and keeping upkeep of the building. They pay taxes and insurance. You have to pay attention to the lease because sometimes the tenant will pay those directly, like they'll pay directly to the taxing authority, twice a year or whatnot. Sometimes they will ask, you pay for it and we'll reimburse you for within 30 days of submission. So, there may be a little bit of passing of paper or bills, but there are leases where the tenant pays everything direct and you really don't have a hand in any of that. And so that's why, it's important to have someone, advise you on what exactly is going to be expected of you, and each lease is very different. And so that's the value that we bring, is going through the lease and really relaying to you, okay, what is going to be expected? Is this a monthly thing where you have to pass a payment, which is usually not? Is this a yearly thing, or there are absolutely no landlord responsibilities at all? So it differs again from multifamily, because you have a long-term lease in place with a corporately guaranteed deal. Most often, big corporations, like I said, McDonald's and CVS and Dollar General, that have, anywhere from 10,000 to 20,000 locations nationwide. And so that's the income, and the credit worthiness is a lot higher than what you would receive on multifamily property.
And then, and that again, and I hear this, and I want to make sure that that's clear to everybody, how important it is to really understand the lease, because it's the lease and the terms of that lease with that retail tenant that dictates what makes a triple net lease property, and spells out all of the terms. And that's I'm a multifamily broker. I own multifamily. I like to think that I know a lot about real estate, but I don't know a whole lot about retail leases. That's not my focus. If I were to get into that, I would want to have somebody help me walk through what that lease says. Because if, let's say, Melissa and Ian, if that retail tenant shifts responsibility for a certain portion of, let's say, maintenance or something like that, how does that alter your relationship to that retail tenant? Is it still a net lease? What kind of variations are there? Would a multifamily owner looking at the market be likely to run into if they're looking to buy, let's say, a Burger King or something, or a fast food restaurant around the country? Are all of them kind of the same in terms of management?
It just depends. A lot are true triple net. A lot of Burger Kings or Taco Bell, it's actually going to be franchise credit. And we actually had someone come to us and they said, a multifamily broker from so-and-so brokerage firm put me into this deal, and now, the tenant vacated the space. What happened? And, we looked at the due diligence for about 10 minutes and realized, we would have never put you into a deal like this. So it's very important to absolutely understand what type of deal you're buying, what type of lease structure it is, and most importantly, who is on the hook to pay you rent, and are they performing well at the location? We don't always get a peek into sales, but when we do, that's important. CBRE also has retail brokers across the country that have sales data and sales information, anecdotal information that we can get over the phone, and obviously the boots on the ground presence that CBRE provides in markets all over the U.S. So again, it is very, very, very important that you have someone on your side who's reviewing not only the lease, but who the guarantor is, how's the location, all of the factors, when valuing the deals and looking at them.
And so let's say if somebody were to enter into an exchange and they're looking at a lot of different opportunities that might be on the market, how do you kind of walk through what those leases are, particular to each deal, and kind of present that to an owner so that they may be able to compare kind of apples to apples?
Yeah, so most times if the deal is on the market, there'll be something called an offering memorandum that will list out types of responsibilities. Where you have to be careful is misrepresentation. So someone says a deal is absolutely triple net. If you don't know the right questions to ask, all of a sudden you may be looking at a property where there's roof and structure liabilities, or they ask that the landlord holds additional liability insurance or something of that nature. So again, it's important that you know the right questions to ask. And many times, we work on behalf of buyers that come from multifamily or that come from industrial or office, and they're very familiar with that space, but they're not as familiar on the net lease space. So again, we know the right questions to ask, and we try to get the full picture when presenting deals to our clients.
Okay, and then guys, one of the things that I hear quite a bit as we're comparing multifamily versus retail is the security. So obviously residential real estate, there's always going to be a demand for. A lot of owners feel that that could be the most secure type of investment, and that there might be additional risks to getting into a net lease property. What happens if I lose a tenant at some point? What happens, is my investment gone? I kind of hear that. So it's like, if the existing tenant that I had and the lease is up on it, what happens then? How do you compare the security of, a residential investment and when you're looking at a net lease?
Yeah, so one of the easiest ways to think about risk is, and I use this analogy a lot, is if you can think about like the corporate bond market or U.S. Treasuries in terms of just risk-free assets. And the net lease market works very similar to that. And every deal is a little bit different. Even if if you're looking at Starbucks leases, a deal, depending on the developer in that market, he may have a certain lease structure that's slightly different than maybe another developer in another market. So you really have to pull back the layers there's no really apples to apples comparison. It's really, really hard to do that. So there's so many variables that go into it. But the fundamentals are credit, term, and the location. So you can kind of bifurcate the value of a net lease deal in really two ways. And it's the underlying real estate, and then also the credit worthiness of the tenant, the ability for that tenant to pay. So we have investors that only want to buy coastal California or in California or urban, the super dense like infill markets, because the underlying real estate is more important to them than the credit. There are a whole there's a whole cadre of investors, and there's even publicly traded REITs that don't look at the underlying real estate. They just look at the credit. They look at it as a financial instrument, and so they'll buy a 20-year Burger King, knowing that it's basically like a 20-year bond. And so they'll look at the credit of that tenant, either corporate or franchise, and the market's pretty good at that's why you'll see, for example, like a Chick-fil-A might be at a 3.75 cap or a 4 cap, a McDonald's be a 3.75, 4 cap, but something that has a junk credit rating or a lower credit rating may be at a 5 or a 6 cap. So that's the same thing. Like if you're looking at a corporate bond, if you're looking at junk bonds versus corporate bonds with investment grade, there's going to be a spread there. And so you look at it the same way, and it's without a lot of experience, it's hard to do that, but we do it day in and day out, and we're able to kind of figure out, and it depends on each investor's appetite for risk. So an investor may say, listen, I have a little higher appetite for risk, so I want a higher return. So I'll look at a shorter term deal, or I'll look at something that has a little lower credit because I like the real estate. And I know, and then you start looking at, okay, what is the rent per square foot? Is that a market rate rent? And so you start just pulling back the layers that way to determine, okay, if this tenant goes out, is this a below market rent deal? And if so, then it's almost considered like a covered land play. So you just got to look at each deal in particular to kind of determine the ultimate value.
Great. And okay, that's great. And I think that kind of ties into we've got some good questions here. One of them had, and Melissa and Ian, make sure you guys can see this, but One of the questions was comparing the cost of retenanting a building. So let's say that lease ends, and you're looking at what the underlying real estate can support. What is the cost of retenanting a triple net lease property versus the kind of turnover that you would have to do for a multifamily building?
Yeah, that's a good question. I don't know that I've ever seen I've never seen that calculation done. I think people look at it more in terms of what is the residual value if this tenant goes away. And so then you start calculating your cash flows. So let's say you pay $2 million for a property and there's 15 years of term, and the underlying value for that property, if it was dark, was $1 million. So you can take those cash flows and discount them, back to today's rate, add the $1 million. And so we those are the kind of calculations that we're looking at. Like, do you get your money back? Do you get your return of capital? And then, there is some estimates in terms of finding a new tenant, providing tenant improvement dollars. Typically it can cost a couple $100,000 to do that, and sometimes more than that. So every deal is going to be a little bit different. It's going to depend on the size of the building. If it's a 2,000 square foot drive-through versus a 14,000 square foot pharmacy building. So each deal is going to be a little bit different. So that's a harder question to answer. But, if you're buying something that has term on it, and the reality of the net lease space, especially if you're buying in the corporate world, I mean, these tenants are, yes, they do sometimes go out of business or they don't renew, but you're buying these investments, and if you do a good enough job, you're hoping that they just stay there and they continue to renew the options. And that's really what we're looking out for when we're putting our clients into those type of investments.
So when you're evaluating the deal, you kind of look at what's called the go dark. So people aren't clear with that. That's the value of the underlying real estate with no tenants there. So just what is the building worth, right? And then maybe you could also factor in what it would cost to maybe imagine what a future tenant might be in a given location. Would you be able to kind of have some sort of idea or figures to understand what it would take to re-tenant that building, or if it's
on a particular
what
deal,
do I need to have,
yes, on a particular deal you would, yes. And so and just to clarify, if a tenant, let's say you buy a Walgreens and it has 15 years of term, and Walgreens is not doing well, and for whatever reason they decide to close the store. Well, they continue to pay rent, they continue to upkeep the building, they continue to, there's no difference to you as the owner. And that's why you would buy, a corporate credit. And those are investment grade. That's an investment grade tenant. So you can go to the bond market and look at a 15-year Walgreens bond, or you can look at what a cap rate is and calculate the benefits of the ownership with the depreciation. And, that's how people start to, underwrite these deals and compare what the cap rate should be.
Okay. This one, another question that we got here, and I hear this also on the apartment side, in terms of a rising interest rate environment. We had a question, do corporate bond spreads have widened with a rising interest rate environment? Do you see triple net lease investment cap rates widening parallel to corporate and treasuries?
Well, not right now. We're in a pretty unique period where just like a lot of things in the economy, there's supply and demand imbalance. There's the market's tightened a little bit in terms of the COVID exposed some weaker tenants that were forced to shut down, that were deemed non-essential. So a lot of the money has been chasing kind of what we call essential tenants, pharmacy, drive-through, dollar stores, grocery. And so a lot of that supply has been sucked out of the market. And so right now, it really is, it's a seller's market. Now, when we see things, interest rates change, the cost of debt change, cap rates typically lag by 2 to 3 months. It just takes that long for kind of the market to digest, what's happening with, interest rates basically. And so we haven't seen that happen. We have seen a slight soften, and some of these cap rates were getting incredibly aggressive, record-setting cap rates, and it's totally anecdotal, but we've seen a little bit of softening on that. So it doesn't mean they're changing course. It just means you can't continue to push the boundaries, or you're not getting the bids. And so we're seeing that happen a little bit. So I don't know what that's going to look like for the rest of the year, but that's what we're seeing in the market today.
Yeah, I would say too that since the onset of COVID, people couldn't go buy shopping centers or multifamily or office because they had tenants that weren't paying rent, and therefore they couldn't get the financing that they needed, et cetera. And so we all of a sudden saw all this influx of capital into the net lease space that was on top of all of the demand that we were seeing previously. And so it just shows that as an asset class, people chase after it because it's dependable, and they know what it's going to look like for the next 15 years, no matter if there's a downturn, no matter if it's COVID, et cetera. And so that's also kind of why we're having the supply and demand, just because the demand is so high for these types of investments right now.
And I would add to that, just from a different perspective in the multifamily space, obviously we've had a pretty significant uptick already in interest rates for multifamily real estate. However, we haven't really seen a parallel rise in cap rates. It's still, given the amount of capital that's out there seeking a home in multifamily, there's still a significant amount of demand that's kind of keeping pricing very, very strong. Now, who knows in the second half of the year if an additional 100 or 50 basis point increase could change that, but so far we haven't really seen a big hit to cap rates generally. So I think there's just a lot of money out there that's chasing these deals, whether you're a multifamily guy or owner, cashing in on that. Maybe you want to trade out of it into net lease. On both sides, both of those are very in-demand investments. So, we're seeing pricing kind of related to that. And again, guys, just for the audience members, if you do have any questions whatsoever, any points that you would like further clarification on, by the end of the call, please don't hesitate. Just type it into our chat feature there, and we're trying to field them as they come. We had another one here asking about the impacts of the Biden administration's proposing eliminating the 1031 exchange with the elimination of interest carry. Will this have an impact on the market? Will this have an impact to these kinds of deals? Guys, have you heard anything on that from the 10? I know this was around particularly last year. For our side,
that was the story last year. That was the fear that was in the market last year, and it did appear to kind of cause investors to make some moves and sell if they were thinking about selling. But I think that fear, we haven't really heard that fear this year. So I think that was that happened last year. I think the so-called smart money doesn't believe anything like that's going to move forward. So right now we're not seeing that. The headwinds that we're seeing right now are just with inflation, rising rates, and geopolitical issues. But the 1031's kind of been on the docket for many, many years. Probably the closest. Last year was probably the closest to it coming to fruition that I've seen, but it didn't happen, and we're not hearing it being talked about anymore.
I think we're hearing the same on the multifamily side. Certainly, that was a motivation to some folks last year. But I think given where it looks like the politics are heading in this regard, we're not hearing a lot of concern from smaller or larger apartment owners. Okay, and I think we've covered a lot of the questions that we had in terms of, what kind of the specifics about net lease and background information. If you have any other questions, attendees, please go ahead and chime in with that. But I also did want to cover kind of the process of getting into a net lease investment if you're an apartment owner. Can you guys talk a little bit about the process of trading? Is it really any different? And the deal size, what size of triple net lease is out there and what can you get?
Yeah. Okay.
So most single tenant deals at this point, really kind of start around the $2 million range. There are smaller properties in the $1 million range, but then you start to go out the risk spectrum on that. Maybe it's a shorter term lease. Maybe it's in a very small town somewhere. Maybe the credit is not as good. But to kind of, if you're looking for safety, looking for low risk, you're going to be in the high $1 million range to really the low twos to between 2 to 3. Melissa, would you say that's accurate?
Yeah, I think that's fair.
So in terms of just the fundamentals for doing an exchange, it would be the same. You have the 45 days to identify, 180 days to close on the property. The 45 days can be very stressful, especially, we try to work with our clients. The buyers that we work with are typically under an exclusive. One thing I forgot to mention earlier is that we do run a buy-side desk here for CBRE out of this office for our clients and our colleagues that make the family office, industrial, their clients that are looking to come in a net lease. So we are at any given time are working with a handful of clients looking to place them into net lease. That is, that's where really where the demand is right now. If you're in the market trying to look on LoopNet or one of these portals for properties, you're probably missing, more than 50% of the market. The market is so tight right now that developers are not really even taking their properties to the market. So we get access to the inventory. We call it shadow inventory. We've been doing this long enough that, if you want a Tractor Supply or CVS or Dutch Brothers, we know who's developing those tenants across the country. And, we'll try to get their shadow inventory list and work deals off market that way. We try to do financial modeling before you make your decision. So let's say you want to sell and you have a $3 million property you want to sell and you need to know what it's going to look like to buy a net lease investment. Well, that's where we do a lot of upfront work. We'll pull a couple different sample properties. We'll do some modeling to show you, okay, you trade, here's your proceeds, here's what your investment's going to look like, and here's your cash flow. And so we do a lot of that upfront work. Going into net lease is a big education. And, we find that it probably takes about 30 days of looking at lots of different properties before a buyer can kind of hone in on what their comfort level is, and, get a good understanding of being comfortable to move forward. So that's the process that we take, but we do try to identify the 3 properties and move forward and move quickly when we find something that we think is a good investment for our clients.
So it sounds like in the 2 to 3 million is where we see the most inventory. I was working actually earlier this year with an owner of a larger multifamily property. They did want to get into a net lease investment. It was a pretty substantial amount of money, so it's difficult to place. But there are obviously deals that are much larger than that. If we're talking about a more substantial placement of equity, how would you guys kind of go about accommodating that kind of exchange requirement?
Yeah, I mean, the net lease world, in any given year, there's probably 50 billion worth of worth of products that trade. So it's a big market, and that could be anything from a $2 million Dollar General to a $50 million Home Depot, or so that's you just think about everything in between. And so like right now it could be an LA Fitness. We have an LA Fitness for sale for 16 million. We have an At Home. I think that's around 12 million. We sold a Ralph's grocery store last year in West Hollywood, around a $40 million range. We sold a Chevrolet dealership around the $35-40 million range last year. So there are bigger trades. FedEx is another good example. So it just kind of depends. There's big trades out there available, bigger asset types. Pharmacies can be anywhere from $5 to $14 million at CVS, Walgreens, Rite Aids. So it just depends on the size of your exchange. Sometimes you have to break it up into 2 or 3 properties, just depending on the size of it.
Well, you touched on another point that I do kind of want to go into, but that's I think it's an important point to remember, both on the kind of assets that are out there and what is the strategy to place any particular amount of equity. When we have a client that's interested in entering into an exchange, we all meet together to really understand what does the financial modeling look like, and do that on the front end. So we start obviously with the apartment valuation, so we really understand how much equity we'll be able to come out of the deal with, and what the financing requirements will have to be replaced. And we actually sit down, as a team here to really understand what that would look like in terms of what kind of net lease property you could buy and what the cash flow would look like and all that kind of thing. So I just want to highlight that point, that it's really a comprehensive strategy to execute these exchanges from apartment buildings into a retail asset. But also part of that is the financing. So could you guys talk a little bit about what the financing picture looks like when you're trying to get into a retail investment? Is it more difficult? Is it different from an apartment building? And how does that factor into the process?
You want to take that one, Melissa?
Yeah. So it's depending on the deal size. It's usually pretty easy. At CBRE, we have a debt and structured finance group that will take the deal, and they'll go out to several lenders, whether it's a life co or a bank or CMBS, to get you a handful of debt quotes, and obviously try to get you the most competitive debt quote out there. And so, historically, rates have been very low, and they still continue to be very low. And so, it's pretty easy just to go through and finance these deals. It may take a little bit longer than getting like a multifamily loan. Typically, we ask for a 45-day financing contingency on a net lease deal, just because there's certain third-party reports that lenders require, such as, a phase 1 environmental survey, an actual property survey. And so, it's just a matter of checking boxes, but it's a pretty simple process. And again, CBRE, handholds through that entire process as well. And so basically it's whatever you need at the time. We fit all the building blocks together. If you need an exchange accommodator, we provide you with names of people that we've worked with in the past, real estate attorneys, third-party consultant companies. We provide you with, contacts for them. So it's really from start to finish, as John said, starting with, the apartment valuation. We are going to be there every step of the way and really guide you through the process. So it's kind of roundabout answer, but yeah, it's very simple to finance these types of deals. You do have to provide, your income tax returns and things like that. So there is a little bit of housekeeping items that you have to get together in order to present to the lender. Usually they're 10-year terms, 30-year amortization, depending on the length of the lease. And like I said, we've seen record low interest rates for the past handful of years. So it just depends on, the property and the credit of the property. Obviously, the lower the interest rate, the better the credit. So it's just a lot of factors go in. And so that's what we take into consideration, when doing that financial modeling. We can even, put in a debt quote to really give you a after debt annual income number. And again, if it's a true triple net lease with zero landlord responsibilities, that number will be your annual rent number. There's not going to be anything that pops up, regarding the building or anything like that would impact that cash flow. And so people, for the next 10 years, you'll know exactly what your annual rent, what your monthly rent will be. And so that's, again, why people like this type of investment.
No, I appreciate that. And again, if anything is unclear, please go ahead and ping us. Why don't we talk a little bit about the example that you guys brought along, about kind of a real world, what it looked like for that apartment owner getting into.
Yeah, absolutely. So we had a very, very, very large apartment owner in a very big exchange. They had multifamily apartments in California that they actually wanted to divest their entire portfolio and trade into single tenant net lease. Again, it was more of an estate planning type of situation where the kids didn't necessarily want to manage moving forward. And so their long-term estate planning strategy was to acquire single tenant retail deals to really minimize the amount of landlord involvement. So this was a Dignity Health freestanding ER that we put a client into in Tempe, Arizona. Again, they wanted to place money outside of California and were attracted to this deal because it was absolute triple net. The tenant was responsible for everything: taxes, insurance, building upkeep. It was a 20-year lease at the time of sale. It had 18 years remaining. This one had pretty good annual rental increases of 2%. And so that was a reason why they were attracted to it. It was a large 1.5 acre site. And dense demographics, obviously, with the university nearby. And so, again, it was their long-term strategy of selling out of their apartments in California. They wanted all of their investments to actually be outside of California. A couple of them were thinking about moving to Arizona long-term. And so, we listened to what they were looking for and, paired this deal. And this deal is actually a bigger size. It was about $13 million.
No, I appreciate that, guys. And so just to kind of recap, some of the points that we hit as, you're potentially evaluating making the move into a triple net. We hear, particularly from apartment owners, this kind of the same thing. We want to get out of the management. We want to get into something that isn't going to be a headache long-term. I've owned these buildings forever. At some point, I don't want to get calls, tenants, are paying or that kind of thing. But also, I want to highlight political risk, and that is, I use that term, somewhat loosely here, but just today, for example, we can kind of get a little bit off topic. The city of San Diego passed an ordinance that removes the ability of a apartment owner to get a tenant out if they're planning to renovate the unit. So essentially, that is locking in a lot of existing tenants, and now that is really going to be challenging to execute the kind of value add strategy that we see very common in the multifamily space. And we do hear more and more owners that are deciding, we're just not comfortable here, or it just doesn't fit in with our business plan. And every day we get something new. So on that particular law, it has not become law yet. It's going to be voted on April 18th. But for anybody that owns units, and myself included, we're kind of going back and taking a look at where we're at and making sure we can kind of get ahead of it. So that's in terms of the motivation, we kind of hear that. And it's a very, very common story to get out of apartments and move, out of the state of California into retail or even within the state, but in a different asset class. In addition to that, obviously, we want to put together a comprehensive strategy in order to be able to execute that. So the attraction is ease of management and simplicity. And from you as the owner perspective, that's the goal. However, getting to that point, obviously, there's a lot that goes into these leases. There's a lot that goes into the evaluation of what's going to make a good trade and what kind of asset you want to buy. And so in that sense, there's some complexity. And that's why I do want to stress that it is so valuable to work with professionals who are specialized in that field. I run into a lot of multifamily apartment guys that will want to do the whole thing. You know, obviously everybody wants to get a bigger fee, and that's fine. However, when you get out of your zone of expertise, relying on somebody who isn't specialized in another market and doesn't have the background and the platform to really vet these deals. And I can't tell you how many times I've heard, stories where these things go wrong, where maybe they just hadn't done their homework or they relied on that multifamily broker to guide them through that strategy, and they just weren't the right people to do it. So that's why when you kind of hear the depth of experience of Melissa and Ian and have that background, it makes all the difference to take the complexity out of that transition and out of that strategy, so that ultimately you're left with something that's going to be beneficial long term, and that is going to be easier to manage and accomplish your goals. So if we have any other questions, particularly on the net lease side, please, again, don't hesitate. We had somebody who did ask kind of a little bit off topic, but I'll go ahead and kind of chime in on it. And if anybody else has something along those lines, was asking more about student housing or other alternatives to multifamily real estate. And I'll just kind of answer that with a general market commentary as things go. You know, despite the fact that we have had some difficulties within as a result of COVID, or economic difficulties over the last few years in terms of ownership, we still see demand very, very strong and cap rates very, very low. So whether you're in student housing or you're another residential asset class, it's still a seller's market. And so even though cap rates have compressed on the retail side, they have compressed still even more on the multifamily side. So it's not uncommon that, particularly if your rents are under market, you could be selling at a very, very low cap rate and still be trading into a higher cap rate, even if it might be in the mid or the low fours or something like that. So it's all very specific. And, of course, we want to make ourselves available. If you have more questions or would like to get something, very tailored to what your situation is, we're happy to sit down with you, take a look at all the aspects and answer any questions on that front. So not the end of the conversation here, but if we have any other questions, I think we've gotten to most of them, but nobody else. Yeah, okay. Well, great. I appreciate and I would like to thank everybody for making the time to listen in and to present. And like I mentioned, happy to sit down and get more in depth on these things down the line. And we'll have a little bit of background information, which we'll send out and follow up. So again, thanks everybody for joining, and we'll look forward to questions in the future. Thanks.
Thanks, everyone.
Thank you.
Thank you.